AG Members Corporate Finance Podcast Series, Episode 4, by Dongseong Accounting Corporation and Audit Alliance LLP. Today's hot topics are Korea Market Outlook, Private Equity Ecosystem, Deal Structuring Toolkit, Cultural Playbook, Origination and Collaboration Opportunities in Korea. Let's get started.
Hello, everyone. Welcome to episode 4 of the AG Corporate Finance Podcast Series, where we explore how capital, strategy, and execution come together across global markets. Today's conversation takes us to South Korea, a market that has been quietly but consistently generating high-quality mid-market M&A opportunities, driven not by hype, but by structure, specialization, and timing. Today, we are joined by a key leader from Dongseong Accounting Corporation, a premier mid-tier firm consistently ranked among the top 20 firms in South Korea. Dongseong is an officially registered public auditor equivalent to PCAOB registration in the USA, meeting the highest global standards for audit quality and transparency. What really distinguishes Dongseong is its cross-border DNA as a founding Korean member of Allineal Global since 2016. The firm has built a strong reputation as a cross-border solution group, supporting both inbound multinationals entering Korea and outbound Korean expertise expanding globally. From international tax structuring to overseas investment and global M&A, Dongseong operates at the intersection of Korea and the world. Today, our guest is Kitae Park, lead partner of the International Department and head of the International Transaction Advisory Center at Dongseong Accounting Corporation. Kitae began his career at RSM Korea in 2001, founded his own firm in 2008, and merged with Dongseong in 2019. He led his firm's entry into Allineal Global in 2016 and recently serving as an AG APAC board chair. Today, as Vice Chair of the AG Global Executive Board and a member of the Global Corporate Finance community, Kitae is deeply focused on cross-border collaboration and modernizing the advisory experience through digital and AI-driven solutions. Kitae, welcome to the podcast. It's a pleasure to have you.
Okay, thank you for having me, and thank you so much for that generous introduction, Sumbul. And I'm very excited to share some underground insight about what's happening in Korea mid-market right now. And there's a lot of noise out there, so I hope today we can cut through it and focus on the real structural opportunities that our community members and folks from Allineal Global should be watching. So I think I'm ready now. Let's get started.
Great. So Kitae, as you mentioned about the Korea market outlook, would you like to tell us about how Korea has been generating a lot of mid-market deal chatter lately? And from your perspective, could you give us an insider briefing on the market beyond the famous case actors? What structural drivers like the inheritance tax should we be watching through 2028?
Well, yeah, that's a very great question, and it's quite a broad one. And if I had to give an insider briefing on Korea's mid-market right now, I would start with this. The story is no longer just about case something as buzzword. It's about high-value specializations underneath these brands. So on the visible layer, the sectors like K-beauty and healthcare and media and entertainment are still the most active phases of Korean mid-market. But the way value is created has changed. For example, in beauty sector, global players like Estee Lauder, everyone knows, the Estee Lauder, they're not just chasing volume anymore. They're looking for kind of indie brands that own very specific digital niches, maybe one category, one community, or one key cross-border channel. And that's where a lot of the mid-market deal actively is happening in Korea right now. In the healthcare sectors, the real engine is medical aesthetics and devices. So Korean Botox maker and medical laser company have been posting strong export growth and very attractive margins. They combine three things that investors like. There's a recurring demand and export scalabilities and relatively lean asset operating structures. That combination explains why mid-market private equity funds are so focused on these platforms. They can see a clear playbook for growing EBITDA and multiple at the same time. Well, if we go one level deeper into what I call hidden heart of the market, you have the semiconductor and EV battery ecosystem. The headlines are always about Samsung, SK Hynix, Hyundai, and Kia, but the real mid-market opportunity lies with their tier one and tier two suppliers. These are mid-sized companies making high-precision testing equipment for high bandwidth memory or specialized materials and components for EV batteries and power electronics. Well, from an investor perspective, these companies are not just replaceable suppliers. In many cases, they are technology gatekeepers with very sticky customer relationships and high switching costs. Once you are qualified into a global OEM supply chain, you become hard to replace. So that's why even when borrowing costs are higher, many of these niche leaders have been able to defend EBITDA multiples in roughly the low double-digit range. So investors are willing to pay for strategic relevance and resilience. Now, the question everyone asks is, if these are such good assets, why are they coming to market? That's where the structural driver comes in. This is the Korean inheritance tax. On paper, the top statutory rate is 50%, but for major shareholder, once you apply the control premium, the effective rate can be reached to 60%. It's huge. So for first generation founders who built their companies over 30 and 40 years ago, that is a huge wall for them when they think about passing the business down to their second generation. It is important to say, but this is not simply a story of a disinterest second generations. In many families, the children would be willing to continue the business, but they face a severe cash crunch when it comes to funding the inheritance tax on illiquid private health shares. So at the same time, there is a growing group of heirs who would rather pivot their family legacy into technology, digital, or overseas ventures instead of running the original core business. This is where private equity is playing a very constructive role as a succession bridge. The private equity funds are stepping in with capital to help families manage the tax burden while also professionalizing management and governance. In many mid-market deals, founders or their families roll over their minority stake, but company moves from a founder-centric model to an institutional model with professional CEOs, proper board of directors, and scalable system. That's creating a steady pipeline of high-quality assets that would not have been available without this tax pressure. So, looking forward to around 2028, I would like to highlight two engines that will shape this deal flow: K-Defense and industrial AI. On the defense side, the Korean players like Hanwha Aerospace and others are winning significant global contracts, and their mid-market supply chains, such as precision component, electronics, specialized materials, need to scale with them. That is generating opportunity in very specific subsectors that are not yet crowded with international capital. At the same time, the Korea's demographic reality is forcing industrial companies to adopt AI and automation as a survival strategy. With the shrinking workforce and rising labor costs, factories are turning into industrial AI like predictive maintenance, automated quality control, and smart logistics, simply to maintain margins. Mid-market companies that can demonstrate a credible industrial AI story are already starting to command better interest and, in some cases, better multiples. So, if I bring all of this together and look out to 2028, I would describe it as a golden window for international investors in Korea's mid-market. On the supply side, you have a peak in first generation founder successions combined with one of the world's heaviest inheritance tax regimes. On the demand side, you have structural global themes such as defense, energy transition, semiconductors, EVs, and industrial AI. That directly depends on exactly the kind of mid-market companies that Korea is good at building. So to put it in one sentence, the tax is the trigger, industrial excellence is the value, and the demographic shift is the urgency. For our members and AG partners, this is the right moment to look beyond the famous case sectors and start focusing on the hidden champions of Korea's mid-market before that window narrows. Back to you, Symbol.
That's a very clear reframing, Kitae. Less about brand level themes and more about specialization beneath the surface. What stands out is how inheritance tax is not weakening the market, but actually unlocking high quality assets that were previously inaccessible. And your 2028 horizon is important. This is a window, not a permanent condition. It suggests that the real opportunity may sit with companies most investors never see in the headlines. We often discuss the maturity of the Korean PE ecosystem. Based on what you see in the field, how are funds currently deploying capital, and what do the exit routes look like for international partners considering the current market?
Well, let me start with how far the Korean PE ecosystem has come. So when private equity first took hold in Korea in the early 2000s, the core playbook was straightforward: financial restructuring. Funds, they bought distressed or non-core assets and clean up the balance sheet and exited quickly when the market turned. That model still exists in their pockets, but it no longer defines mainstream Korean PE these days. So today, leading Korean funds, names like MBK Partners, Affinity, IMM, and others, operate much more like operational doctors. They don't just provide capital. They bring in management expertise, digital infrastructures, and global best practices. When they acquire a mid-sized manufacturer in Korea, they install proper ERP systems, modernize the supply chain, and strengthen governance, and often recruit a professional CEO. The focus has shifted from financial engineering to genuine operational value creation. That shift is visible in where capital is being deployed. Generally speaking, I see three main spots here. The first, consumer and food and beverage sectors. The brands with strong domestic shares and clear potential to scale into South Asia, China, or the Middle East, these companies already have recognizable brands and loyal customer bases, and private equity helps them build integrated channel and cross-border strategies. Secondly, healthcare and medical devices, especially medical aesthetics and diagnostics with recurring revenues and export potential. Once they secure approvals and distribution in a particular area or country, they can generate very sticky cash flows. And the playbook is clear now. The professionalize quality and compliance, expand into new markets, and build up broader product pipelines. The third, the industrial tech and manufacturing. So particularly tier one and tier two suppliers to Samsung, Hyundai, and other global semiconductor and automakers. These hidden champions often operate with EBITDA margins in the mid-teens to around 20%, if you like, supported by long-term relationship and technical know-how. Many of these companies are available for sale, not due to poor financial performance, but rather because founding families face succession challenges and significant inheritance tax burdens. That creating attractive investment opportunities for private equity investors. Now, on the exit side, the evolution has been just as important. Historically, the Korean PE relied heavily on IPOs as their default exit route. But in recent years, public markets have become more volatile and selective, especially for mid-market names. But valuation can be sensitive and listing window can close quickly. As a result, there has been a clear shift toward more secondary deals and strategic M&A, including sales to global conglomerates and large industrial buyers. For international investors, the interesting part is what I would call PE policing asset, which typically come with three advantages. The first, the cleaner financials and governance. By the time a fund is ready to exit, the company usually has audited financials from a major audit firms and transparent reporting and a simplified equity structure. That reduces execution risk for overseas buyers. The second one, the professional management. One of the biggest challenges in buying directly from founders in Korea is succession risk. In private equity-backed companies, that risk is often largely addressed. A professional CEO and leadership team are in place, and the organization is used to KPI and structural reporting things. And the third, and they are more ready to integrate. Because operational and governance upgrades are already underway, integration timeline can be meaningfully shorter. Sometimes at 6 to 12 months is shorter than we acquiring a traditional family business and fixing issues after closing. For a global strategic buyer, that time to value difference is very, very critical. So, what does this all mean for international investors looking at Korea today? In many cases, buying from a Korean PE fund is lower risk than buying directly from founders, even if the headline multiple is similar. You are paying for a de-risked, institutionalized, export-ready asset. At the same time, the Korean private equity fund increasingly need reliable global partners. Many PE funds are approaching exit window, and they cannot simply rely on domestic exit alone. The global strategic and financial sponsors, on the other side, want credible, vetted entry points into Korean supply chains and consumer markets. Where these interests meet, cross-border collaboration become powerful. Local PE funds and advisors originate and groom assets. International partners bring platforms, synergies, and capital. And because Korean valuations still often reflect domestic exit pressure more than full global strategic value, there is an arbitrage opportunity. If we work together on origination and structuring, the Korean sellers get clean exit, The Korean PE fund secure timely liquidity, and global buyers acquire high-quality assets at attractive risk-adjusted prices. In that sense, maturity of the Korean PE ecosystem has created not just an opportunity to invest in Korean companies, but an opportunity to partner with Korean funds as sophisticated, repeat co-builders and exit partners over time. I think, I'm done for this question. Over to you, Symbol.
What you are describing, Kitae, is a very mature PE model, operational, institutional, and globally aligned. The shift away from IPO only exists towards strategic and secondary sales, clearly benefits international buyers. In many ways, PE has already done the heavy lifting, governance, management, reporting, which reduces
Right.
execution risk. You are not
Mm.
buying a story, you are buying a prepared platform. And very well
Right.
said. Kitae, moving to the next question about deal structuring. I believe bridging the bid-ask spread is a perennial challenge. How are tools like earnouts and W&I insurance being used effectively in Korea to make deals more digestible for international buyers?
Here's another tough question. Well, in Korea's mid-market, the valuation gap are almost built into the system. A big part of that comes from what I called the founder's premium. The first generation owners price their companies based on the decades of their sacrifice and upside they still believe in, while global buyers look at evidence-based performance and risk. That easily create, let's say, a 20 to 30% gap between what a seller feels is fair and what a buyer can actually underwrite. In today's higher rate environment, international investors are more disciplined. They need clear proof of resilience before they pay up. The question isn't whether we can avoid a gap, it's how we bridge it without breaking the deal. In Korea, three tools have become quite standard for that. Earn-outs, warranty and indemnity insurance, and rollover equity. I'd like to start, with earn-out first. In high growth areas like healthcare, medical aesthetics, or niche tech, sellers want to be paid for future growth, while buyers don't want to fully price in forecasters. Earn-outs turn their attentions into a shared bet. Typically, 15 to 25% of the consideration is linked to post-closing performance over 1 to 2 years. If targets are hit, the seller effectively gets their price. If not, the buyer is protected. It is a practical way to move unproven growth risk back to the seller without blowing up the deal. The second, warranty and indemnity insurance. The Korean founders have traditionally disliked and hate large escrows and long indemnity tails. They want a clean exit once the deal is done. W&I insurance has become a very effective bridge, especially in cross-border and P-lead transactions. Instead of relying heavily on sellers' indemnities, many of those risks are shifted into an insurance policy. For international buyers, they reduces the trust gap and gives more comfort when acquiring in a different legal and cultural environment. For seller, it means more cash at closing and fewer open-ended worries. Third, rollover equity. More and more, buyers expect key founders or families to retain a 20 to 30% stake after the deal. If the founder genuinely believes in the company's future, keeping some ownership helps make sure everyone walks towards the same goal during the handover. It also lowers execution risk for the buyer because the founder who built the business remains invested while professional management and governance are implemented. Once these tools narrow the gap, here's the next question. What actually justifies a premium in Korea today? Increasingly, investors are looking at the digital MOAT. They are less impressed by actual EBITDA growth and more focused on whether margins are sustainable. Are margins protected by automation, data, and system, or are they vulnerable to rising labor costs and demographic pressure? Companies that can demonstrate strong digital capabilities, such as AI-powered planning and quality control, automated workflows, and data-driven decision-making, are beginning to command higher valuation multiple than their competitors. Put it simply, technology has become the primary way to protect against Korea's structural challenges. So, in a market where valuation gaps are normal, these tools, earnouts, WNI insurance, and lower equity, combined with a serious focus on the digital MOAT, are what make Korean deals genuinely digestible and attractive for international buyers. I think I'm ready for the next question, Simbo.
Thank you very much, Kitae, for the insightful, practical view of valuation, not ideological, but workable. Announced WNI insurance, rollover equity are not just financial tools, they are alignment tools. And the emphasis on a digital mode is critical. It's becoming the main driver of sustainable multiples. Margins today are judged less on the history and more on survivability. My next question, Kitae, with you is, as we know, execution is everything in M&A. So if you talk about the cultural playbook, what are the unwritten rules of the Korean market, such as the emotional closing or labor nuances that international investors should prioritize for a smooth transaction?
Yeah, this is the part where I usually tell people everything you learn in business school, yeah, that's still useful. But in Korea, there's a whole other syllabus. Let me walk you through it. Okay. So when deals fall apart in Korea, it's rarely because the numbers don't work. It's usually because something breaks at the human layer. So if I had to give international investor a practical playbook, I would focus on three things: the emotional closing, high context communication, and labor relations. First, the idea of emotional closing. In Korea's mid-market, many companies are still run by first-generation founders who have spent over 30 or 40 years building the business. For them, the company is not just an asset. It's more like their son and daughter. So even after the price is agreed, their biggest concerns are often about legacy, not valuation. We see questions like, will you keep the brand name? Will you protect our longtime suppliers and employees? Will the culture I built simply disappear? If buyers treat the transaction as a purely legal and financial exercise, we sometimes see last minute hesitations or what I'd call seller's remorse right before signing or closing. The way manage this is very intentional. You don't just negotiate a share purchase agreement. You co-create a narrative about what happens to the company after closing, on how the brand, people, and relationship will be respected. That emotional journey needs as much planning as legal timetable. Second, the Korea is a kind high context culture, and that shows up very clearly in negotiations. A lot is communicated indirectly through silence, body language, and relationships rather than explicit words. For example, When a Korean counterpart says yes in a meeting, it often means, I understand your point. It doesn't mean I fully agree and I'm ready to commit. Direct, confrontations that might feel normal in the Western negotiation cultures, but it can easily be perceived as disrespectful and aggressive in Korea. That doesn't mean you cannot be directive. It means you need someone at the table who can read between the lines, translate nuance, and advise you when yes actually means not yet or even no. I often talk about the role of cultural mediators, a local advisor or partner who can interpret these signals and help both sides adjusting their style. That mediator can be the difference between a smooth signing process and weeks of silent resistance. The third, and the very concrete, is labor relations. Many Korean mid-market companies still operate under a family-style leadership model. Employees have grown up with the founder, and there is a deep emotional bond. When ownership changes, especially to a foreign buyers or a PE fund, employees naturally become anxious. Will there be a layoff? Is our bonus structure changing? Is the company being flipped? These questions will be arising. So Korea labor's laws give employees strong protections, and collective sentiment matters a lot. We've seen cases where a change of control triggers employee protests or where workers demand consolation bonuses because the founder is perceived to be cashing out. This is not just about money. It is about employees feeling they are being left behind when the person they trusted steps away. The smart buyers conduct what I call human due diligence. They don't just check financials, contract, and intellectual property things. They actively assesses the organization chart, key talent, informer influencers, and union or workers' council dynamic. Then they build a labor integration plan that emphasizes job security where possible, clear communication, and visible respect for existing staff. Handling this well can prevent disputes that are both time consuming and legally complex in this country. Finally, all of these feeds into what I'd call the integration mindset. The real question to the buyer is not only can we close the deal, but also can this organization actually work inside our global structures? You need to assess whether mid-level managers can adapt to more transparent reporting, global compliance, and different decision-making styles. In a market where retaining key talent after closing is crucial for value creations, understanding these cultural and labor nuances is not a soft issue. It's a core risk mitigation strategy. So, if I summarize the cultural playbook in one line, manage the founder's emotional journey, not just the legal process. Navigate Korea's high context communication with patience and the right local intermediaries, and treat labor relationship and human due diligence as seriously as you treat financial due diligence. Deals that respect these three dimensions tend to close faster and integrate more smoothly in Korea. So I think that we only have final questions. So let me back to you, Simbo.
Thank you, Kitae. And your idea of emotional closing is particularly relevant for international investors. It's not just a transition, it's actually a high context communication, and labor sensitivity are not soft considerations, they are actually risk management. And as you mentioned, spreadsheets may be universal, but the interpretation rarely is. Moving on to our next segment, which is about the origination and collaboration. Kitae, finally, a question for you, for those listening who care about deal origination. So, where do you see the best opportunities for advisory firms to collaborate on Korea-related M&A? And how is your focus on modernizing the advisory experience intended to support these joint efforts?
Okay. When we talk about Korean M&A, I think the real opportunity for advisory firms is moving from just executing deals to finding deals early. The old way where we share deals only after they're already being marketed doesn't work as well anymore. Once a company enters the formal auctions, prices get competitive and it is hard for us to, as advisor, to stand out. Where I see the most value for our association is early stage origination, finding the right Korean targets before they appear on everyone's radar. For my partners, I don't want to be just a local contact. You call when you need a due diligence report, but I want to be your smart gateway into Korea, someone who aligns on your client's need upfront and then uses local knowledge to source targets that fit those needs very specifically. That's how we create a genuine first mover advantages that even the big four, they cannot easily replicate. To do that, I'm building what I call a digital first boutique model. The idea is simple. Combine that relationship driven partner led service of a boutique with real technology capabilities behind the scene. In Korea, Bali culture, which literally means hurry, hurry, and reflects the country's fast paced business environment, speed and timing matter a lot. So, our plan is to use AI and data tools to scan thousands of corporate filings, tax records, and public disclosures and find companies that are reaching important turning points, especially those likely to face the inheritance tax wall and succession issues. We discussed earlier this well before they formally come to the market. For you and your client, that would translate into something very practical, pre-market deal flow. Instead of joining an auction at round two with 10 other bidders, you can sit down early with the founder who is just beginning to think about successions, professionalizations, or international expansions. That is where structure, creativity, and cross-border partnership can really add value. Looking ahead to 2028, the ambition is to move from simple data collection toward predictive insight. The goal is not just to say, oh, yeah, here is a Korean company in your sector, but to say, here is a company where, based on the data, we can reasonably estimate the efficiency gains, margin improvements, or cross-selling upside after integration with your client platform. In other words, I don't just want to send you a teaser. I want to send you a kind of roadmap for value creations that can take straight to your client. The digital first approach is support our association in two directions, I believe. On the inbound side, if you have global buyers looking for tech, healthcare, or industrial assets in Asia, I can give you a curated shortlist of Korean companies that match specific criteria. Technology edge, financial quality, and cultural fit. That moves a big part of the commercial and cultural due diligence upstream and makes your cross-border advisory work far more efficient. On the outbound side, there is a huge opportunity many people underestimate. Cash-rich Korean conglomerate and mid-caps are actively looking for overseas IP and technologies to hedge against domestic demographic risk and a slow growth home market. By sharing information within our association, we can match these Korean strategic needs with tech-heavy companies in your local markets, whether that's Europe, the Americas, or the rest of Asia. My vision is to turn this into a kind of cross-border matching engine. The Korean buyers with capital and industrial platform on one side, and your local growth companies with technology and market access on the other. By connecting them with a digital roadmap that shows how value can be created post-deal, with shift from being a transaction center to a value creation center for everyone in this association. To sum it up in one line, the future of Korea-related M&A for advisory firms is to prioritize origination over execution, leverage a digital-first boutique model for speed and insight, and use AI-driven analysis to bridge inbound and outbound opportunities. My door is open to every one of you who wants to co-design that pipeline. If we work together this way, I'm confident that we can originate and win the next great wave of Korea-linked deals. Well, I think, that covers the 5 key questions we set out to explore today. We've walked through market dynamics and sector rotations, the inherent tax challenges, driving mid-market deals, what foreign buyers often misunderstand about Korea, and the cultural and labor nuances that makes or break integrations. And finally, how we can work together on early stage origination using a digital-first approach. My hope is that this conversation gives all of you a clear roadmap for navigating Korea's unique M&A landscape. The opportunities are real, the timing is favorable, and the key is to act early with the right local insight and cultural intelligence. I'm really excited about what we can build together through this association, and I look forward to partnering with many of you on the next wave of Korea-linked deals. Thank you for having me today, and back to you, Sumbo.
Thank you very much, Kitae, for the very insightful discussion from execution-led advisory to origination-led partnership. Early access, predictive insights, and pre-market alignment are where advisors can still create real differentiation. What you are describing is an advisory model that moves upstream, closer to strategy, not just transactions. That's where long-term value is created for clients and partners alike. Kitae, thank you very much. This has been an exceptionally insightful conversation. Korea's mid-market clearly offers depth, structure, and timing for those willing to understand it properly. To our listeners, thank you for joining us on the AG Corporate Finance podcast. We look forward to continuing these conversations in our upcoming episodes. Thank you very much.
Thank you. Thank you for your time and effort. Thank you. Bye-bye.
Thank you, Kitae. Thank you.
Bye-bye.
Bye-bye.